Every long-term investor will live through multiple market crashes. That is a certainty, not a possibility. The stock market has crashed dramatically dozens of times throughout history, and every single time it eventually recovered and went on to new highs. The investors who built wealth through those crashes weren't smarter than everyone else, they just didn't sell at the bottom. Today, we're covering why panic selling is so psychologically compelling, why it's almost always the wrong move, and exactly what to do instead when the market is falling and everything feels terrifying. When your portfolio drops 25 or 30%, the feeling is visceral. You open the app, see a number significantly smaller than it was 3 months ago, and every instinct tells you to do something to stop the bleeding, to get to safety, to preserve what's left. This reaction is not irrational. It's a product of loss aversion, a well-documented cognitive bias where losses feel roughly twice as painful as equivalent gains feel pleasurable. Losing $10,000 hurts far more than gaining $10,000 feels good. Evolution wired humans this way because avoiding losses was historically more important for survival than capturing gains. But financial markets are one of the few environments where that instinct works against you. In a market crash, the danger is temporary. The damage only becomes permanent if you sell and lock in the loss. Investors who held through the 2009 financial crisis, the 2020 pandemic crash, and every other major downturn saw their portfolios fully recover and then some. Investors who sold at the bottom locked in losses they never recouped. When markets are falling and the news is catastrophic, it helps to have some data anchored in your mind before the panic sets in. Every market crash in history has been followed by a recovery. The average bear market, defined as a decline of 20% or more, lasts roughly 14 months. The average recovery to previous highs takes about 2 years. Some recoveries are faster. The 2020 pandemic crash saw markets recover their losses in roughly 5 months. Some take longer. But the direction of travel over long periods is always upward. Missing just the 10 best trading days in the market over a 20-year period cuts your total return roughly in half, and those best days almost always occur during or immediately after the worst periods of a crash, when panic is highest and the temptation to be in cash is strongest. The investors sitting in cash, waiting for things to settle down, consistently miss the sharpest recovery days. As mentioned in a previous video, time in the market beats timing the market, not as a cliche, but as a statistically documented reality across every major market and time period studied. Here's a concrete action plan for the next time markets drop sharply. First, do nothing. Seriously, close the app. The urge to act during a crash is almost always counterproductive. Your investment plan was designed for long-term performance, not short-term comfort. A bad day or bad month is noise. Your 10 or 20-year return is the signal. Second, keep your automatic contributions running. If you have automatic monthly contributions going into your TFSA, do not pause them during a crash. You are now buying the same ETF units at a lower price. This is a feature, not a problem. As mentioned in a previous video, this is the power of consistent investing. You buy more when prices are low without needing to time anything. Third, if you have extra cash, consider buying more. Market downturns are sales. The underlying businesses in your globally diversified ETF haven't changed in value as dramatically as the price suggests. Markets overshoot in both directions. Deploying extra cash during a significant correction is one of the highest return moves available to long-term investors. Fourth, review your risk tolerance honestly. If a 30% drop is causing you genuine distress and affecting your sleep, your portfolio may be more aggressive than your actual emotional tolerance allows. As mentioned in a previous video, the best portfolio is the one you'll hold through a crash, not the one with the theoretically highest return. Here's the summary. Crashes are certain, recoveries are certain, and the only permanent damage comes from selling at the bottom. Have a plan before the crash happens, because in the middle of one, your emotions will be working hard to override your logic. Write it down if you need to. When markets drop 20%, I will do nothing. I will keep contributing. I will not sell. Read it when things get scary. Next week, we're covering a topic that affects anyone who has money in a Canadian mutual fund: why most mutual funds in Canada are dramatically underperforming their fees, and what the numbers actually look like when you run the math over 20 or 30 years. Subscribe, and I'll see you there. See you then.